So keeping in tune with that previous article, I have another one here for you. This is from Bloomberg. This is from Stephen Krabil, I think is how you say his last name. He writes, billionaire Paulson, who shorted subprime, calls crypto a worthless bubble. The investor also explains why gold is poised to surge on this interview with David Rubenstein. So John Paulson is a very, very famous investor, and he says in this interview, he, quote, wouldn't recommend anyone invest in cryptocurrencies. I have two articles here. We're going to talk about John Paulson, and then we're going to switch to another Bloomberg article here from Mark Mobius. Both of them talking about crypto, both of them talking about gold. I know you guys, a lot of you are Forex traders. Gold is a commodity. It's very important to us. And I know a lot of you guys are also interested in trading crypto. So this is going to apply to a lot of different people here. I'm not going to read you the entire conversation between Paulson and Rubenstein, but I think a couple of pieces here are important. So to start, he says, ever since John Paulson bet against the U.S. housing market more than a decade ago, people keep asking about his next big trade. The billionaire hasn't found anything to rival his massive short, but it's hard to top the $20 billion that Paulson made for himself and investors when subprime mortgage bonds collapsed and ignited the world's worst financial crisis since the Great Depression. So he made $20 billion in 2008, 9, and 10. It's not a small amount of money, that's for sure. Now, 14 years after CDOs and credit default swaps dominated everyone's attention, Paulson is again seeing signs of excessive speculation. He's 65 years old. He's increasingly concerned about rising prices. He said in an episode with David Rubenstein, the rapidly expanding money supply could push inflation rates well above current expectations, he said. And gold, which he's backed for years, is primed for its moment. His harshest words are for the hottest investments of the era, SPACs, on average, will be a losing proposition, while cryptocurrencies are a bubble that will eventually prove to be worthless, he says. I wouldn't recommend anyone invest in cryptocurrencies, Paulson told Rubenstein. Paulson's dismissal is sure to attract critics after digital assets vastly have outperformed gold in recent years. His record since the greatest trade has also been mixed. He turned his hedge fund into a family office last year after assets dropped about $9 billion in 2019 from a peak of $38 billion in 2011, and he found himself managing mostly his own money. Paulson said he much prefers to focus these days on investing and doesn't miss the stress of running a business. I was never fond of raising money or going to meet investors, he said. Investing is what he largely wanted to do since attending a course at NYU taught by former Goldman Sachs chairman Gustav Levy. After Harvard Business School, Paulson's first job was with Boston Consulting, but he soon switched to work for Odyssey Partners, then mergers and acquisitions for Bear Stearns. So he's worked around many big financial institutions. He opened Paulson & Co. the year before I was born in 1994, and the New York-based firm was best known for risk arbitrage until that moment when he realized the U.S. housing market could be a house of cards. The interviewer, Rubenstein, says, the subprime trade was more than 10 years ago. Have you or anyone else come up with something quite as good as that? He says, I haven't found anything as asymmetrical as that particular trade. Asymmetrical meaning you could lose a little bit on the downside, but make essentially 100 times on the upside. Most trades are symmetrical. You could make a lot, but you risk a lot. And if you're wrong, it hurts. But the area that's most mispriced today is credit. You have current inflation that's well in excess of long-term yields, and there's a perception in the market that it's transitory. I think they bought the federal line that it's just temporary due to the restart of the economy, and that it's eventually going to subside. However, if it doesn't subside, or if it subsides at a level that's above 2% that the Fed is targeting, then ultimately, interest rates will catch up and bonds will fall. In that scenario, there are various option strategies to bonds and interest rates that could offer very high returns. They go on to talk about gold a little bit more. He says here, so you're a big believer in gold as a good investment. Yes, we thought in 2009 with the Fed doing quantitative easing, which is essentially printing money, it would lead to inflation. But what happened was while the Fed printed money, at the same time they raised capital and reserve requirements in the banks. So the money sort of recycled. The Fed bought treasuries, created money, which wound up in the banks and then was redeposited at the Fed. Just this circle of money. And the money never really entered the money supply. So it wasn't inflationary. However, This time, it has entered the money supply. The money supply was up about 25% last year, and the best indicator of inflation is the money supply. He says the best indicator of inflation is the money supply. So I think we have inflation coming well in excess of what current expectations are. Are you a believer in cryptocurrencies? He's asked. No, I'm not. And I would say that cryptocurrencies are a bubble. I would describe them as a limited supply of nothing. So to the extent that there's more demand than the limited supply, the price would go up. But to the extent that demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies except that there is a limited amount. Cryptocurrencies, regardless of whether they're trading today, will eventually prove to be worthless, he says. Once the exuberance wears off or liquidity dries up, they will go to zero. I wouldn't recommend anyone invest in cryptocurrencies. So like I said, you guys can go on to read this article. They're talking about some price forecasts about Bitcoin, a little bit price forecast about gold. Does he think Bitcoin's going to make it to 100,000? All of that is discussed in this article. But why I wanted to share this with you is because you have one super well-known investor here in John Paulson, super well-known hedge fund guy, very successful from 2008. But again, that was an asymmetrical trade. He then says that because of all the inflation, because of the money going into the money supply from the Fed, not just being recycled by the banks like it used to be, because the money has now gone into the money supply, he's saying that commodities like gold and silver are poised to rise. That comes at the same time as we get this article about Mark Mobius, another hedge fund guy. He says to hold 10% in gold as currencies will be devalued, not digital currencies. He's talking about real currencies. So what Mark Mobius says is that investors should have a portfolio of 10% in gold as currencies will be devalued following the unprecedented stimulus rolled out to fight the coronavirus pandemic. He says 10% should be put into physical gold, Mobius said, who set up Mobius Capital Partners more than 3 decades at Franklin. Yeah, so he had, history at Franklin Templeton, started his own firm. He says currency devaluation globally is going to be quite significant next year, given the incredible amount of money supply that has been printed. Again, another hedge fund guy saying there's too much money in the money supply. It came flooding in too fast. Bullion rallied to a record last year as the coronavirus pandemic spurred a flight to haven assets, but it's pulled back since with the rollout of vaccines. To fight the crisis, central banks and governments worldwide have unleashed an unprecedented wave of monetary and fiscal stimulus, boosting balance sheets at the Federal Reserve and elsewhere in other banks, and straining state finances. He says it is going to be very, very good to have physical gold that you can access immediately without the danger of government confiscating all the gold in the world. He's been a longtime fan of gold. Spot bullion, which traded at right around $1,816 an ounce, hit an all-time high above $2,075 about a year ago. Year to date, it's shed more than 4%. It's down more than 4%, while global stocks hold a near record and the Fed lays out a strategy to par stimulus. Investors have been turning away from bullion-backed exchange-traded funds amid the continued strength in equities. A global tally of gold-backed holdings has fallen 8.5% over the last month. So Mobius is saying that you should be holding physical gold because of what's coming, not because of what's happening right now. You got to understand that. We know stocks are at an all-time high, and we know gold and silver are not breaking out for new highs right now. But that doesn't mean that they're not a good investment at their current prices. I'm still a big believer in these two commodities because whether the prices are artificially suppressed or it's natural market behavior that is keeping the price low, I think within the next 5 to 10 years, you will be seeing gold at $3,000, $4,000, $5,000 an ounce, and you should see silver over $100 an ounce as well. Once the real effect of all the money that was printed is felt by us on the consumer level, now that it's in the money supply, increasing the inflation. CPI numbers, PPI numbers, they're never going to be that accurate because we know that they're painted a certain way. They're counted a certain way that the Fed then uses them almost like a public facade. They refer back to those numbers when they're the ones probably influencing those numbers. But the real inflation, the price of goods going up, and like he said, the money entering the money supply, that is the issue. And once that's come to a head, once that's really felt, I believe you're going to see gold and silver and other commodities continue to go up. And I think you're going to see chicken and meat and cost of goods that we purchase every day also continue to go up. I don't see that reversing anytime soon. And it's sad because what does that do? Take this a step further, right? Don't just talk about it on a financial aspect. Talk about it on a socioeconomic aspect. It's creating a bigger divide between the rich and the poor, the people that own the assets and the people that own nothing. And those people that own nothing then need UBI, they need government assistance. What does that do? Makes the government tax us more, blah, blah, blah. It's this never-ending circle of mess, but the mess divides us more. The rich get richer and the poor get poorer, and the gap in between them gets bigger. It's not just that they're getting richer and they're getting poorer. The gap is bigger. It's harder for people to cross over into that level. So it's very important that we kind of try to paint this whole picture and understand that even though commodity prices are lower right now, that doesn't mean they're not a good investment for 5, 10, 15, 20 years into the future once this inflation comes to a head. And maybe we do see the end of the melt up in U.S. equities that we've seen over the last, you could say 10 years, but I would say just even in the last year since the coronavirus false crash, so to speak, that was induced. But I want to know what you guys think. Are you buying gold, physical gold? Are you buying ETFs of gold? What are you guys doing to hedge against inflation outside of crypto? I don't care what you're doing in crypto because I kind of sit in the boat. I was watching his video with Shaq yesterday. It was a conversation with him and the guys from Full Send. And he was saying, I don't know any crypto. I do businesses. I do other investments, things that I know about or that I trust people to tell me about. He's like, no one in the crypto space is trustworthy. And same thing that you're seeing these hedge fund guys say. Yeah, they're old. Yes, they're old. I get that. But that doesn't mean they're not smart. I think a lot of young guys are just like, oh, these old guys, they don't get crypto. Don't listen to them. I don't think that's the right approach. These guys have been successful in the past, and success in the past can normally dictate success in the future. Not always, but normally. So I want to know what you guys are doing to hedge against inflation. Tell me in the comments other than crypto. Are you buying physical? Are you buying the ETFs? What are you doing to hedge?